Let's walk through this together. The big question this week: are we about to miss the next wave of winners, or are the risks bigger than they look? Wall Street just dropped a flurry of fresh calls on the biggest US names: Tesla, Nvidia, Microsoft, Apple, Oracle, plus Walmart. And the signals are mixed but mostly bullish. I'll guide this like a coffee chat for a Singapore investor, and we'll follow the Substack article step by step so it's easy to track. If you're new here, I've spent years breaking down US markets for Singapore-based portfolios, so this should save some research time. So here's the plan. First, the major investment thesis: why AI and growth are driving the optimism. Then the AI thread tying Nvidia, Microsoft, and Tesla and CoreWeave together. Next, Apple's mixed signals. After that, the Oracle divide. Then we'll hit the strategy implications for US and international investors, the risk checks, the market context, and a simple, staged portfolio playbook. Finally, a quick conclusion on why selective optimism beats blind indexing here. So, first up, major investment thesis: AI and growth drive bullish sentiment. The pulse is upbeat. 10 of 12 calls are positive. The average upside, based on targets, sits around a quarter. So this isn't a meh week. Imagine the summary table from the article for a second. It's basically a heat map of optimism, with Tesla and Microsoft standing out, Nvidia still strong, and Oracle split down the middle. Why should that matter to us? Because sentiment tends to lead flows, and flows move prices, especially when it clusters around a theme like AI. Here's where it gets interesting. Tesla pops right off the page. Deutsche Bank lifted its target to the mid-400s, which implies a huge upside from current levels. That call ties to stronger Q3 volumes and momentum into deliveries. For practical decisions, the question is not, is Tesla hot? But is the risk-reward still worth it after a big run? Hold that thought. We'll bring it back when we talk time horizons. That brings us to artificial intelligence, the common thread. Think of it as a stack. Nvidia sits at the silicon layer, the chips everyone needs. CoreWeave is the rental warehouse of compute for AI jobs, the pick and shovel play. Microsoft is the enterprise wrapper that monetizes AI through cloud and software. Tesla is the applied layer in the real world: autonomy, fleet learning, and energy. If the AI boom is a supply chain, these four are each a critical link. The table in the article lays this out cleanly. Nvidia dominates chips, Microsoft monetizes cloud AI, Tesla pushes autonomy, and CoreWeave scales capacity on demand. The takeaway? If AI demand keeps compounding, these names are aligned to capture the spend, each in a different way. Quick note for clarity. When analysts say capacity additions are tracking ahead, it means data centers are still racing to stand up more GPU racks. That's why you see price targets inching up. The TAM looks bigger, earlier than expected. But the constraint is supply and power. So the thesis lives or dies by build-out speed and software adoption. Now, mixed signals from consumer technology: Apple. Think of Apple here as the barbell between device cycles and services growth. The article's Apple table is simple but telling. iPhone sales still large, services still rising, total revenue strong, and iPhone up double digits year over year. Yet, analysts are split. Evercore sees upside, powered by pro-tier strength. KeyBank says the stock might be a step ahead of demand. So what do we make of that? If new device demand is merely good, the services engine is the ballast. For a Singapore investor, that's code for if adding steady tech exposure, Apple still fits the core position bucket. But maybe don't expect fireworks without a fresh product catalyst. Next, Oracle, the controversial divide. This is where the room argues. Bernstein says growth acceleration and stays bullish. Rothschild & Co. Redburn initiates at sell with a big downside target. Both can't be right in the short run. What's driving the split? Cloud economics and the sustainability of non-EAAS parts of Oracle's story. When investors crowd into AI infra names, enterprise software with shifting margin profile becomes a battleground. My simple way to look at it: if the next two prints don't show clearer visibility on profitable cloud growth, the bearish view gains weight. If bookings and cloud gross margin trend improve, the bull case firms up. Strategic investment implications. For US-based portfolios, the tilt is obvious. AI infra and hyperscaler beneficiaries should be core. That means Nvidia and Microsoft as foundation stones, Tesla as an optionality bet with higher variance, Apple as stability with services ballast. For international investors, especially in Singapore, two quick notes. 1. Currency. Big upside targets magnify FX swings. Having some SGD USD hedging rules helps, even if it's as simple as staged FX conversion rather than lump sum. 2. Withholding. U.S. dividends face withholding at source. So growth-heavy names where dividends are light, like Nvidia, TSLA, lean cleaner on after-tax returns, while dividend payers, MSFT, AAPL, need a simple spreadsheet to track drag. If that feels heavy, set it once and reuse the template. By the way, if you want all the reference tables, checklists, and the written version, everything's on Substack. The link's just below. It's handy to keep the upside comparison and sector mapping in one place. Risk assessment and critical considerations. Let's be direct. Oracle's sell call is a warning about enterprise demand quality and long-term cloud economics. Tesla's 74% target bakes in aggressive autonomy progress and resilient EV share against China competition. Nvidia's risk is supply normalization, demand digestion, and any shift in AI workloads that reduce GPU intensity. Microsoft's risk is that AI attach rates are slower in mass enterprise deployment than the hype implies. Apple's risk is device demand flattening without a breakout new category. So how do we handle that as Singapore investors? Use position sizing rules. Cap single name exposure, ladder entries, and keep a stop loss or time-based review rule not to day trade, but to stay honest when the thesis changes. Market context and timing. The backdrop is supportive. Recent months showed the S&P catching a bid with strong YTD gains and a friendly rate cut behind growth equities. That helps multiple expansion for AI leaders. But rallies can compress future returns, so stagger buys. If the table shows big upside, don't chase in one go. Scale in. Portfolio strategy recommendations. Near term, 3 to 6 months. Focus on AI infra beneficiaries, Nvidia, Microsoft, because enterprise spend is still ramping. 6 to 18 months. Tesla as the high beta call option on autonomy and energy. Apple for steadier compounding. Beyond 18 months, Oracle only if comfortable with volatility and the cloud margin debate. Walmart for defensive ballast with modest upside. If this were an actual Singapore-based portfolio, I'd think in buckets. Core, MSFT, AAPL, satellite growth, NVDA, high conviction optionality, TSLA, defensive, WMT, and special situation, watch list, ORCL. Then run a simple rule. Don't let the optionality bucket exceed the defensive bucket. Imagine the final comparison table. It lines up current prices, targets, and upside. Tesla and Microsoft glow bright on potential. Nvidia still looks strong. Apple offers a calmer slope. Oracle splits the room. Walmart sits there like a trusty anchor. For many, the next best action is to upgrade the core with MSFT NVDA on pullbacks, then earn the right to size into TSLA as catalysts clear. Conclusion. Selective optimism required. The article's final point holds. The opportunity is real, but dispersion is wide. That's why conviction should live, where fundamentals and adoption curves are clearest. AI infra is that zone. Tesla demands respect for both its upside and its risk. Apple remains the quiet compounder. Oracle, watch the data, not the debate. Here's my honest take. In my experience, what matters most is staying disciplined on entries and size. If I could give just one thing to remember, build the core first, MSFT, AAPL, add the engine, NVDA, then layer the upside bet, TSLA, with rules. Keep a simple FX and withholding tracker for Singapore portfolios. And revisit the thesis quarterly. Don't anchor to old targets. If this was helpful, drop a comment. Which name are you watching this month? Tesla's catalysts, Microsoft's AI monetization, or Nvidia's supply ramp? I'd love to hear the plan. By the way, if you want the tables, checklists, and my full write-up, everything's on the Substack. And if early access and members-only portfolio clinics sound useful, consider joining the premium membership. It's a small group, very practical, and focused on building smarter Singapore-based US equity portfolios. If you're lining up the next video, check out the deep dive on AI infrastructure positioning. It pairs perfectly with today's playbook.